Okay, so we continue with the second part. Yes, it is the portfolio construction and behavior of capital market. So, under the traditional finance, the EMH or the efficient market hypothesis assumes that the market is perfect and there is no more opportunity to earn more return than the index or the market risk free rate plus the market risk premium. And a fundamental manager or a technical manager cannot earn more rate than the efficient market or the market as a whole, which is telling you that this is the market which has all the information which is priced in. So there are three forms. One is the WFE, which is the weak form efficient, semi strong efficient, and strong form efficient. So in the weak form efficient, it includes all the past price and volume data. But over here, the fund managers cannot earn alpha using technical analysis. It cannot be used using technical analysis is because you have all the technical data of past, the price and the volume data. But in the weak form, you can still make some money if you have internal news or any fundamental data which is not available in public domain. Any fundamental data or internal news which is not available in public domain, wherein the information is not transparent. This is a weak form efficient. It is usually seen in developing markets. The second part is the semi-strong. So this was the weak, wherein internal. If you have internal information, you might be able to earn some alpha. In the semi-strong, it also includes all the historical price and volume data and public business data, not the private. But managers cannot earn alpha both fundamentally and technically. Again, the same thing. It has all the price and volume data, but you cannot earn anything more than your risk-free rate plus market risk premium or the market rate, because all the public business data and all the technical data is already in. Over here, you could still make money in case you have internal news, even in the semi-strong one. But in the strong form efficient, it includes all public and inside data, that is private data, and managers cannot earn alpha. So what this theory is telling you that in essence the efficient market hypothesis says that the market is efficient and there is no more way to earn more money. So there is no point in doing active management of portfolio because the market itself is efficient. Might as well buy an index fund, right? Because the market is providing the maximum return. But due to the developing nations and the developing markets which are still undergoing a lot of changes, there are few markets where the entire market is not that efficient. It is weak in that sense. The entire information is not reflected in the prices. So in case you have more information on the company or you have an internal news, you can make some money other than the market return. Then there are countries which are developing like India. Over here, most of the security prices, public business data and everything is transparent. So that is why you cannot earn more than what the market is giving using fundamental and technical data. But obviously, since insider trading is very much possible in India and other developing nations, because the rules as compared to the US SEC is very, very different in India. So the filing rules, the transparency is very, very different. So that is why in case you have internal information, you can still make money. But in the strong form efficient, that is some US markets and all those markets, you will never be able to make money more than the market because it includes all public and internal data also. Having some problem technically today. Okay, so these were the efficient market hypothesis. So there are some challenges, fundamental challenges, that usually it is believed that the value stock is better than growth in long term, but you might see a market showing growth stocks as more dominant for a very long period of time. That is because of human behavior chasing the growth stocks. Then in the from a technical analysis perspective, the moving average theory is like the simple moving average or the exponentially moving average. All these data points are these data points, sometimes they show that okay, these technical things are working, and and the investor believes that okay, using the technical analysis, they they can actually make money. And Sometimes it just gives you that impression. So these are some challenges fundamentally and technically. And there is some calendar biases also. So if you have calendar anomalies also, so there might be some stocks, which run only in certain periods, or consistently these stocks or these sectors have been outperforming the broader market in this duration of the year. So these are some calendar anomalies which can occur in any market, and these poses a challenge to efficient market hypothesis, because efficient market hypothesis says using fundamental, technical, or any chance correlation you cannot earn more than the market rate. But there are anomalies like growth stocks might outperform the value stocks. So, for a prolonged period your technical analysis works, and the simple moving average theories like simple moving average or your relative strength index logic, RSI, these logic might work. And there may be some calendar anomalies wherein certain sectors outperform the market during certain periods of the year. Okay. So in contrast to the traditional finance, wherein we have seen all these models, there is a big comparison with the behavioral finance, and what kind of models you can use to understand the behavioral finance as to why and how the investors are behaving the way they are behaving. So the first is consumption and saving. So in a traditional finance, the rationally economic men, the assumption is he saves and invests the money in the market, and because of that, he foregoes the current consumption and invests that money and saves that money to bear the fruit in future, to have a retirement goal in plan, to have a retirement portfolio in plan. He foregoes the current consumption to have money in future. But the behavioral finance tries to capture those factors which impact this thing, which is lack of self control, wherein a person does not have discipline of investments and money. They have some biases, some framing biases, and they do mental accounting. So example of lack of self control could be not managing their money properly, buying riskier assets, or in contrast to their actual risk taking capability. Then mental accounting is basically investing those money which they have not received from their regular income. Say suppose they have got $1 million, say $100,000 as their bonus. So this $100,000 they say, okay, this is not coming from my salary. Let me go and play a lottery out of it. So this way they are just parking the money which they have earned into certain things which they consider is not part of their current investments and income. So this is a mental accounting. So contrary to the TF, behavioral finance is impacted because of the consumption and saving habits of individuals. Then there is a behavioral asset pricing model. So over here, as we all know, that investment is more of sentiments and your temperament more than your knowledge, right? Even Warren Buffett has said that he's not the most knowledgeable guy in the world, but he's the most patient and the most the guy with the most temperament in when it comes to having patience in the market and not following the crowd, controlling your behavior, knowing your facts, right? So the all this when you combine it comes into a broader perspective, which is your sentiment. What is the sentiment of the market? So what the behavioral asset pricing model is saying, it is the traditional CAPM model. What is the traditional CAPM model? The risk-free rate plus the beta of the market to the market risk premium, right? RM minus RF. A sentiment premium is added to the CAPM model to determine general market or behavior expectations. So if the sentiment premium, if the market is upbeat, so let's see today, because of the COVID-19 scenario and all these things, the demand has soared up all across the globe. So the sentiments are high, so it will have a positive sentiment premium. So your expected return will be more. That's what happening in the market globally. All the markets are up. This is because the consensus, the behavioral pattern which is being shown by the investors and the traders is that the sentiment is good. The COVID is behind us. The world will bounce back strongly, and the demand will go up. So that's a sentiment premium. Then we have the BPT, which is a behavioral portfolio theory. So over here, what it says that contrary to the TF, Here you have a layered or goal based portfolio. So in the TF, what you'll have a single portfolio with a goal of a risk and return and a horizon, some risk profiling that you have done. But in the behavioral portfolio theory, you will have, say, portfolio one for, say, suppose your child education, and maybe portfolio two for your retirement. But what happens in behavioral portfolio theory, and the major difference between goal based investing and behavioral portfolio theory is, when you're doing GBI or the wealth management, you're actually considering your entire portfolio as a whole. Even if your portfolios are in layer, you're still considering the entire portfolio as a whole. But what happens in BPT is basically investor might end up with two portfolios which are highly correlated to each other. Say suppose it is a correlation of 90 example. Now what will happen when the market is good, both will be performing well, they have a high correlation. But what happens when there is a crisis? This will fall and this will also fall if the correlation holds true, right? So whenever you're doing a BPT based portfolio, this thing, there is a risk that overall portfolio is not taken into consideration. You're not considering portfolio two while developing your portfolio one, or you're not considering the portfolio one constraints while developing portfolio two. You're just having a single vision of that portfolio and con- uh, constructing that portfolio. Then the final one is the adaptive market hypothesis. It is basically that people who can take the heat of the market, or who are learning while trading in the market, they are the one who remains in the market. The rest of them leave the market. And it is as the name says, as adaptive people who continuously learn, adapt to the current market based on their historical failures and successes. They move ahead in the curve, and they remain in the market. The rest of them leave the market. And one more thing over here is that investors who apply such kind of logic, they look for more satisfaction than optimal allocation. So in the behavioral finance, always remember, you will never have an optimal allocation. The reason for that is of these biases. And in traditional finance, you will have an optimal allocation because it assumes that the investors are rational thinkers in terms of investments. So this is more from a behavioral finance. Four models you have to remember. You can just keep it as a short form: BABC, behavioral asset pricing, adaptive market hypothesis, behavioral portfolio theory, consumption and saving. Quite simple that way. So we move to the part which is often confusing for everyone. In fact, me, I have also got so much confusion in this, even after studying it so many times. Obviously, because it does not come naturally to us. We are not habituated to such things. Though it is a very logical thing, but it does not come naturally to us. So, what are the behavioral biases of individuals? Okay, so before we go to the behavioral biases, we have to understand that from the slide one, we understood that there are two types of biases: emotional and cognitive. So, right now, we are going to see the cognitive part. What does cognitive mean? Cognitive means is basically lack of knowledge, faulty reasoning, memory errors, and biases. And these can be corrected via education or training. So, what are the two types of cognitive errors? Belief, perseverance, and information processing. I mentioned over here that conclusions are mentioned in red. So, I'll just change my color. Yeah. So, here I mentioned that all the conclusions of the biases are mentioned in red, so that you can understand there and then what are the impact of this kind of a bias. The first one is the conservatism, that is, hold old views even if new information is available. So we took the example of Facebook, wherein a person who is having a good view on Facebook fails to adjust his view and fails to adjust incorporating new information like competition laws or any penalty that the government has levied on it. So this is known as conservatism. Conservatism. So what are the conclusions? They are unable to change the view. They hold position too long to avoid learning and incorporating new information. So if I have, say, suppose let's take an example where I'm losing money. Okay, let's take an example of, say, an Indian stock which is DHFL. Right now we knew that what happened to the founders. We know what happened to the company. Okay, but if as an investor you're holding this stock, say, let's suppose 100, and the current market price is, say, $20. Now, when this stock was at 40, the news came in that the founders have been, barred from trading. The company will be liquidated. The stock was at 40, right? But you failed to incorporate this new information in your thinking. Had you thought about this and you took that informed decision, you would have sold at 40. Now, because you failed to incorporate that new information, you're still holding the stock at 20, right? So that is concluded. Hold positions too long to avoid learning and incorporating new information, and this leads to holding losing stocks, right? Then confirmation biases look for information to support their old view. So let's take the same example, DHFL. Let's take the same example, DHFL. You had invested at 100, you got the information at 40, but now the current market price is 20. Now, in this example, confirmation biases. Now, if your portfolio manager is telling you, okay, please, get rid of this stock so that at least you can save $20. Otherwise, this company is going to get delisted or liquidated. But what you will say, okay, no, yesterday I read in the paper that the banks are going to rescue it. But you did not read. There was another article from the court which says, okay, this company will be led to liquidation. So you are trying to look for only those information which support your worldview that this stock should be held, right? You're purposefully ignoring the negative news, and at the end, what happens? You end up with a concentrated stock, and you obviously when you have a concentration risk, you are under diversified. The next one is the representativeness bias. It in that the investor believes that history will be repeated, and they adjust the new information accordingly. Within that, there are two sub points: base rate neglect and sample size neglect. So, base rate neglect is holding initial probability as true. So, this is probability as true and performing further analysis on the same. So, over here, what we are trying to say over here is basically in the base rate neglect, whenever initial classification is not adequately considered. So, so for an example, so how do we understand this? Okay, let's take an example that uh, the initial classification of any stock with that, okay, this stock is a good ESG stock. Okay, we will say that this stock is a good ESG stock, which is environmental, social, and governance. It's trading in the green energy. It is making windmills, and it is going to be the future. Okay, so you are holding the initial probability as true and performing further analysis on the same ESG stock, but you are not incorporating the new information that this company is also involved in some bribery case, or this company has been penalized for work ethics, or this company has been penalized for pollution. Maybe. I'm just taking a hypothetical example. So what you are doing, you're holding your initial probability and initial thought true, and you're planning your investments on that, but you're not taking the new information and changing your base rate. Your base rate and the base information is not being changed, very much close to conservatism. Then the next one is sample size neglect. It is basically you take decisions on a small sample. Say example, you want to buy a telecom company, and you know that okay, 10 of your friends are using the same telecom company as a provider. You might just go ahead and buy that stock, whether even if you don't know what is that company's actual presence, how many subscribers they have. Just because your friend circle, 10-15 people have it, you go and invest in that stocks. The next one is illusion of control and hindsight bias, a very simple one. In illusion of control, the investors believe they can control the outcome basis their belief. So this is very common to new investors, even experienced investors. So so let's say an example. I made some money in my first trading day. I made some, say, 10K USD on the first day, and I traded at in a stock which is, was trading at X level, and I used to sell it at Y level. On the next day, what happened? The stock again came back at X level. I again entered into that stock and kept to sell at Y. Okay, I believe that okay, this will again happen. I have traded into this. I have control over this. I will have this will again happen, and the stock goes on moving on the downside, but you fail to sell it. It is because your bias is so strong that okay, 2 3 days I've traded in the stock. These are the levels that the stock should hold, but clearly the market is discounting that stock, but still will not sell it. So what happens? You end up doing ad hoc trading. You under diversify yourself, and you might also get involved in revenge trading, wherein you will say, okay, okay, since it is gone now, let me add more and average my position over here. I will add keep on adding my position because of my belief that it should close at Y. Hindsight bias is a selective memory of past events and actions. I knew it all along. It's very common in if you open your news channels, and all those analysts sitting over there, they will always remember what good they have told about a stock, but they will never talk about the failures that they have mentioned. So it's a very common trait, and it is one of the cognitive errors that you have to look for. So this is under cognitive errors. We have done the belief perseverance, wherein your belief persists irrespective of the market movement, irrespective of the actual knowledge of the market. Under the cognitive, we have the second, where is information processing biases. Over here, it's basically more to do from your cognitive ability, the ability to do things in an intelligent way, or maybe in a normal way. So the first one is the anchor and adjustment bias. So anchor and adjustment bias is basically it is very close to conservatism, wherein you hold your initial view and you do not change your view based on the initial anchor, or the ability that you have, or the prices that you had thought about while entering into a transaction. So basically, when let's say that I have investment in some stock, say A, and I do the stock while investing in A. I thought that okay, government will support this sector. Says it's a defense sector, government will support this sector, and this sector will go up, and eventually my stock will go up. This was my initial view. This was my anchor view. Now the new information has come that another private player, say private player B, has come in the same sector, and he is rapidly expanding. So you will take that information into the picture. You will take that, okay, you will consider, okay, there is one more player, there is a competition in place. But what you will not do is basically, you will not change your view. You will not change your view. You will still believe that A will outperform B, even though that a player has more muscle power, it has more, uh, more money than company A. It has a good pedigree, a brand pedigree than B. But you will just believe that since your anchor or your initial call was that I will go with A, and this sector is going to boom. Now you know there's a new player. You have taken him into the cognizance. Okay, there's a new player. You have adjusted your values and all this thing, but you still believe your initial view, right? So this is one of your anchor and adjustment biases. Another thing could be like, if an analyst doesn't want to go wrong, okay, he doesn't like to get on the wrong book. He's coming on TV every day and he doesn't want to go on the wrong book. He will still hold his, saying it's true. Yeah, this is the buy call that I had given. I stick with my buy call and all those things. So this is an anchor and adjustment bias. Mental accounting bias, we have seen explained this in the last slide also, that money is treated differently based on where and how it's sourced and categorized. So if I get a bonus, I might get enter into risky securities, even though it is not good for my portfolio. As per my risk profile, I should not get into risky security. But I believe that okay, the money that I got from my bonus is basically a money which I can, it's a free money, so I should take into account some risky investments. So that is called as a mental accounting. So layered portfolio, high correlation, that is one of the conclusions. Framing bias is basically how the information is presented. So you often see that whenever there is a result season or the result day, the company will always quote EBITDA. They will quote the EBITDA. They will also quote the ROA, but they will very seldomly quote ROCE or ROE. So in the channels, in the TV channels, you will see that these two numbers are very, very bold. It's the biggest font on the screen. And often they will show you only quarter over quarter EBITDA, because if their year over year EBITDA is lower, they will not show it. They will show it, it's a quarter over quarter EBITDA. So they want to show the information which they want you to believe. If they want to show you the information that the company has done well, they will show you quarter over quarter EBITDA, even if the bottom line is negative, or even if the net profit is negative. So based on how the information is presented to you, you take your decision. So this is called as framing biases. Faulty risk assessment and ad hoc trading and investment activity. Availability bias is basically the decision is based on the available data, memory, and simple calculations, simply like recent events. So this could be one of the very simple things that a lot of investors do. It basically whatever they have faced, or read about a certain stock recently, they will do that thing only. So under the availability bias, you can have multiple causes like retrievability. If the info is quickly retrieved, it's taken as is. So someone tells you, okay, what is your thought on Tata Motors? So you will say, okay, it's a Tata company. Tata is a good company. Let's invest in it, because all you know is that Tata is a good pedigree. But there could be something wrong with the stock. There could be something wrong with the sector. So you only, based on your retrievability of your information, you take the decision. Then again, categorization. Decision is based on categorization, ignoring individual categories such as growth stocks category. So if I say that, okay, let's invest in all electronic vehicle companies. Let's invest in Tata Motors because it's going into electronic vehicles. So I'm just categorizing my information without even actually doing analysis on Tata Motors. The next one is using sample data that we have already learned about. Using sample data to believe that the entire population will also have the same category. The last one is very common and very much applicable to retail investors, which is the resonance. If an individual likes what he reads and listens and discusses, he adds it to his belief. Say you're going to a party, you have hold a Tata Motors for 1 year long now. Now you go into a party, you meet a guy, you're having fun, you're having drinks, and he also says that okay, yeah, Tata Motors is looking good. Two, three more people come and says, yeah, okay, Tata Motors is looking good. So you tend to believe what you hear, what you discuss, and if it adds to your initial belief, you go on holding that stock without actually looking at the data. Obviously, this will lead to suboptimal asset allocation, as decisions are being made on data being fed to you, like media, news, cover papers, stockholders, statements, and all those things. So these are the cognitive biases from an information processing biases, right? Information means what is showed to you, or what you have as part of your analysis. And in the earlier one, you have belief perseverance. That is your based on your belief. Now this is based on the information, belief and information. Two parts of the cognitive errors. The last one is emotional biases. So what are the emotional biases that a investor will exhibit? I think so. This is very common. Me and you can actually correlate with this thing. So first one is the loss aversion bias, where we have more frame from a loss than happiness from equal amount of gain. So this we have seen in prospect theory, wherein I have an investment, I have 10% gain over here and a 10% loss over here. But when I have a loss, I have more I feel more bad when I have a 10% loss. But when I am 10% positive, I don't feel that much happiness. So more pain from a loss than happiness from equal amount of gains. And obviously, you don't want to take the loss. You hold positions for too long. House money effect treats money traded from trading as a different source. So this is again a part of loss aversion bias. Overconfidence bias is overestimation of own intuitive ability and reasoning, taking credit for what goes right and blaming external factors for failures. Self-explanatory. Self-control bias lacks self-discipline and favors extreme short-term gains over long-term goals. So self-control bias is, say, suppose, for example, your company has given you a 200K check that you have performed very well today, and the market is booming. What you do is, without studying the market, you just invest the money in the market, right? And the market might be at its peak before correcting and then going moving ahead. Now you had no control over your emotions to actually consult a fund manager or consult a portfolio manager, look for the actual investments. You just pulled in the money into this, and when the portfolio went down, rather than holding the security or studying about it, you sold it. You sold the security over here, and from the very next month or next week, the stocks again move ahead. This is because you're disciplined. You're not disciplined investor. You're not a disciplined investor. Then status quo bias is basically comfortable with the current situation, unwilling to change. So let's take that you went into a job with, say, Microsoft example, and you have got Microsoft shares, right? Now, though your Microsoft shares might have given you good returns and all those things, your fund manager is telling you that you're concentrated in your portfolio. Diversify this thing. There are other companies, which having lower correlation in Microsoft. You should invest in those. But what you'll say, no, let it be the way it is. I have been comfortable with this in my past, life. I need to continue with the same. I don't want to change you. That's a status quo bias. Then there is an endowment bias and regret aversion bias. So what is endowment bias? Asset is felt more special because it's already owned or gifted. Suppose a husband or wife have owning a company, right? But the husband dies and the wife has the shares of the company. Now gradually the wife gets older and now the company is spinned off, and now there's some another owner of this stock, and now the company is not running well. The wife still holds, say example 10% of that stock, but now the company is not performing well, right? But the wife might not sell the shares because it's from his husband who is no more now. So yeah, she has an emotional feeling to that stock. She might not just sell it, which is called as the intangible sense of comfort, or an intangible thing, or a feeling, right? Then the regret aversion bias can be both: do nothing due to fear of being wrong, and FOMO, which is fear of missing out. So when the market is falling, most of the people never invest. 95% of the people never invest because they fear that if they invest, they could be wrong, the money will fall. And when the market is booming, 95% of the people will invest. Why? Because of fear of missing out. That's called regret aversion biases. So we have two more slides. Let's cover this quickly. So what we saw over here was the behavioral biases of individuals categorized into cognitive errors and emotional biases. We also have the impact of behavioral finance on the investment process, right? So under the in this chapter, there are a lot of models that need to be remembered, a lot of definitions. So just take it with a pinch of salt and just go through this slide. This will be more than enough to get you through the exam. That's what my belief is. That could be my bias also. Okay, let's move ahead. So there are behavioral models which was developed by different people, in which they classify the investors. Okay, so there are multiple models. The first one is the Barnwell two-way model. You can just remember this as B2W. Just take another color so it looks better in this one. Okay, B2W, wherein they say that the investors are either passive or active. So passive investors could be people who have got good inheritance amount. They are very well paid. They have a lot of savings, or people who are disciplined. They invest only in bonds, only in deposits or index funds. So those are passive wealth accumulator. Second one could be active, someone who is trading every day, who is researching every day, who is looking for opportunities, who is looking for growth companies. You know, a typical fund manager who is doing an AIF or a long short kind of a fund is an active manager, and a fund manager who is doing more of a index fund will be a passive manager. So the first model was B2W. I don't know if you can remember Barnwell, but you can surely remember B2W. So BBK5 or the Ballard, Bale and Kaiser model, which is BBK5, they categorize the investors into five categories. The B2W was two, which is passive and active. So these one categorized into five categories: adventurer, celebrity, individualist, guardian. So if you take this as a quadrant of four direction, adventurer, here is the adventurer, high risk taker, confident, concentrated portfolios. So he's between northeast. That's what written in the book, northeast quadrant. Celebrity, anxious, seeks and takes advice. Southeast. Individualist, confident but careful, decisions post thorough analysis, rational investor. You can see this is on the careful side. So the left hand side is on the careful. Confident and careful, individualist. Careful and anxious, guardian. Concerned about future wealth and asset protection, seeks advice from knowledgeable people. Southwest. So the agenda is very clear that there are four types of investors. Let's not take the fifth one right now. Let's take the fourth type. Adventure, where he is confident of his investments and is willing to take more risk. Then we have the celebrity, where he is not confident but he is taking more risk. He is not confident but he is taking more risk, but he is ready to take advice from others. Right? The adventurer guy will not take advice. He would do an active management. This guy will take advice from the other people. Then there is careful and confident individualist. He will always take advice from his portfolio manager, but decide on his own, right? Then there is a guardian who will again take advice from others. So other than this guy, everyone is ready to take advice from others. And the straight arrow is basically average investor, moderately confident, education and information based risk taker intersection. So, so there could be some percentage of people who could lie everywhere. They might show all the traits in some of the other part. So these are the BBK5 model: adventurer, high risk taker, celebrity, risk taker with knowledge, individualist, careful and confident, looks for advices, guardian, anxious and impetuous, but looks for knowledge and is open for discussion. So we learnt about B2W model, BBK5 model, and then is the PM4 model. Hey, this ink is not working properly. So the PM4 model is the Pompian model. Okay. So over here, the investors are defined in passive preserver, friendly follower, independent individualist, and active accumulator. Now, the word itself will give you a self-explanatory. Passive preserver will be conservative, will be emotional decision making, and doesn't understand financial jargon. That's why he's passive, right? Friendly follower, moderately conservative, cognitive decision making. Independent individualist, high risk investor, cognitive decision making. Active accumulator, aggressive investor, emotional decision making. So the PM4 model says that the investors are of four types. One is the passive, one is the active, same like B2W model. The passive will have very less knowledge, that is why he will show emotional decision making. The active will have more knowledge, but he will have no control and self discipline. That is why he will also show emotional biases. The two types of investor which are in between, friendly follower and independent individualist, will show cognitive decision making. They are high risk takers and moderate risk takers, but they believe in looking at the data, looking at information, taking advices from others. Okay, so there are some limitations on of these models, like an investor might show multiple types of behavior during different life stages, and it also change basis on the preference of investment. Temporary change in behavior due to market condition and personal situations. If the person has got a big lottery, he might just go into the risky ventures, or if he lost a lot of money, he might just go into a risk free kind of a investments. So we come to the last slide, which is how the behavioral finance and the investment process is important for a client advisor relationship. So the client advisor relationship should be consistent with a long term view and as per the client expectations. Behavioral finance helps the relation to be maintained in a healthy manner. See, what happens is when you are knowledgeable and your customer is not, but he is showing you some kind of traits that you believe is going to hamper his portfolio and is not going to help him in the portfolio, then you might just want to educate that guy. Okay, look, your portfolio is this, but if you don't follow the instructions, you might end up in a negative portfolio, or you might just outlive your assets. But the customer might not be impressed with your language, he might not be impressed with your skills of making him understand. So behavioral finance is more on the soft skills rather than knowledge, and it is basically how you manage your customer expectations and manage his belief and take into account his beliefs so that you help him to go through his investment process. So in the behavioral finance, one thing is that in the traditional risk profiling, wherein there's a question based risk profiling, the behavioral factor is ignored. The behavioral factor is ignored. So because of that, what can happen? Two kind of biases might end up. One is the framing biases. Suppose when the customer is responding to your IPS, he is in some in other world, he's in some bigger problem of his life, or he might have just read something about growth stocks, which is not good. So he might not select growth as a question in your risk profile. You know, even though he's a good risk seeking investor, he might not look for growth based stocks. An advisor may or may not differentiate the casual comment by the customer or serious mandatory requirement. So this is again important. Like whenever you're writing the IPS for the investor might just give a passing comment, and the it's upon the analyst. He say, suppose the investor says, "Yeah, I don't like to invest in commodities," and if the analyst takes it as a literal comment and he takes it too seriously, he might just end up with a suboptimal allocation to the sectors, right? Because he has just taken a casual comment too seriously. Or if a customer is too serious about that thing, but the analyst believes that okay, the customer is acting such because he doesn't know. Let me apply my brain and give him this sector, irrespective of his IPS recommendations. So that this could be leading to the issues in the suboptimal allocation. So these are some factors which impact the portfolio construction. These are the biases. We know these biases. We have seen this. The BPT differs from MBO as MBO takes return risk as the matrix and BPT is based on layered portfolio theory. So when we understood BPT, we understood that in BPT, an investor might have layered portfolio. He might have one portfolio for retirement, second portfolio for child education. But the problem with BPT is that the correlation of these two portfolios is not studied, and mostly these two portfolios are not constructed in a similar manner or with the consistency. So what happens is in the times of crisis, these portfolios underperform. Contrary to a MBO, which is a mean variance based portfolio, the only inputs which goes are the return and the risk, right? The return and the risk, not the goal for which the portfolio is being created, or not the behavioral pattern for which the portfolio is being created. So that is the big difference. In the BPT, the portfolios are layered. So since analysts are also humans, so they are also impacted by these behavioral factors. So certain important issues could be overconfidence, confirmation bias, and framing biases. And the remedies is basically to use cognitive reasoning, should follow a Q&A based or a survey based analysis, should continuously document and monitor the external internal factors affecting the opinion. Not like that the analyst says, okay, let's buy the metals sector, but he's not incorporating the recent downgrade of metals, the recent price price loss of the metal sectors and the commodities. So all these factors needs to be taken into consideration by an analyst before he actually moves on to give more analysis on that sector or investment process. I think so. We have completed this behavioral finance. It's a very important topic to understand from an exam perspective. Thank you.